Hey everybody, Smart Silver Stacker here. Got a lot to cover today, so we're just going to get right into it. We are seeing a big sell-off in assets across the board. Stocks are falling today in a very big way, and this is of course on top of the big correction that we saw last week. So assets across the board continue to fall. Gold and silver under some pressure as well. Silver down over 2%, down to the 2176 level. Also seeing Bitcoin sell off in a big way, down another 6% today, down to almost $32,000. So this sell off is accelerating, and unfortunately, I don't really see any reason from a technical or a fundamental standpoint that we would see this sell off stop anytime soon. I mean, predicting things in the short term is extremely difficult. We might get some kind of a dead cat bounce or a, quote unquote relief rally soon, although we're not getting that now, and there's really no sign of it at this moment. I want to draw your attention to this chart of the federal funds rate because I think that this is important in understanding what's going on in markets right now. And this is going back to the late 90s, and we can see that there's a pretty definitive pattern here to the federal funds rate, and that is that every time the Fed over the past 2 decades or so has attempted to raise rates, something in the market has broken, and we have seen them forced to reverse policy. And I think that probably we're going to see that happen again soon. And one thing you'll notice is that if you take a line and you were to draw a line from these peaks downward, you'd get this downward sloping trend line, and it's a trend line that we're going to be approaching soon. This chart only goes back to April, so it doesn't really show the recent increase in the federal funds rate, which is now at 0.75% after the recent FOMC meeting, where Jerome Powell announced that increase of 50 basis points in the federal funds rate. But if we take a look at the history of the federal funds rate here, we can see that in the late 90s, they were raising rates, and then we got the tech bubble that popped, and then also the 2001 September 11th terrorist attacks that forced the Fed to drop rates again to rescue assets and rescue the economy. And, obviously they dropped them down too low and they inflated a big bubble so that when they tried raising rates in 2005, 2006, they triggered the subprime market crash, the 2007, 2008 financial crisis, where of course they slashed rates way back down close to zero. And they kept them that way for several years, further reinflating the bubbles. Then in 2016, they started to raise rates again, and that lasted for a few years until we got that repo market crisis in 2019 when they were forced to begin slashing rates again. And then, what we got in 2020, I'm not going to say it because it's sort of the thing that must not be named. I don't think the algorithm likes it very much. But they were forced to slash rates way back down to zero, and they inflated what we have now, the mother of all bubbles, basically. And now, as the Fed begins to raise rates into this environment of recession that we're entering into, we're going to approach that downward sloping trend line very soon. And, we may already be there because look at what's happening in markets just with the Fed raising rates by 0.75% now. The markets clearly cannot tolerate that, and that's pretty predictable because the boom in stocks that we've seen over the past 2 years has been the result of Fed monetary policy. It hasn't been the result of any kind of fundamental improvement in the economy. In fact, all the money and relief programs and all that stuff, basically it just inflated a bubble, and it prevented any kind of fundamental improvement in the economy because we didn't get the benefits that you get from a recession, and that is that the inefficient players in the economy, they go out of business, their assets are sold off, and they can be put to productive use again. No, instead, we kept all these zombie companies alive. We just pumped up asset bubbles by shooting cash out into the markets. You had Robinhood investors with stimulus checks bidding up speculative tech stocks, and we're seeing the NASDAQ get the worst of this, and I think that is a result of that speculative bubble that we had in tech stocks. Just look at something like Etsy. Here's a 1-year chart of Etsy, and you can see that it is down from a high of $294 back in November of last year, all the way down to $86. So a huge haircut there. And that's the story we're seeing across a lot of these meme stocks, a lot of these tech stocks that were bid up during the past 2 years. And, this is the predictable result of having this kind of centrally planned economy. You get these wild swings, these assets getting inflated. And if you don't think that we have a centrally planned economy, by the way, some of you listening out there are thinking, no, we have free markets, we have capitalism. Well, just think about this. Interest on credit is the cost of money, and the Fed is setting interest rates, and money is half of every transaction in the economy. So basically, the Fed is setting a critical price of something that is half of every transaction. So, if you don't think that that is central planning, then I don't know, you should probably take up another hobby other than economics, because that is so clear on its face. If you can't understand that, I don't know what to tell you. Inflation is definitely getting onto the radar here of the administration and the powers that be. Tomorrow, Tuesday, President Biden is supposed to give a speech on inflation. He's going to be targeting the GOP, according to this. And I don't know what that means exactly. I guess we'll have to watch that speech. I suspect that there's going to be a lot of finger pointing. The president is going to blame Republicans, I guess. He's going to blame Vladimir Putin. He's going to blame the war in Ukraine. He's going to blame global supply chain disruptions for rising prices. But he is going to ignore the most important cause of inflation, and really the only real cause of inflation, and that is profligate spending, debt monetization, record low interest rates, easy money Fed policy. That is what creates inflation. It's very predictable. There's been plenty of people, myself included, who have been warning about this for years, the potential rise of inflation, the rise of consumer prices. And, now we're just starting to see that. Now, the president, clearly is kind of clueless about inflation, I think. And this article mentions how on March 31st, he tapped the Strategic Petroleum Reserve for an unprecedented release of oil to help lower gas prices. Moves like that, that is clearly just a political move. That is trying to temporarily lower prices to boost your poll numbers, because honestly, releasing petroleum from the Strategic Petroleum Reserve does absolutely nothing to actually combat the root causes of inflation. And, also from just a policy standpoint, this is not the kind of emergency that the Strategic Petroleum Reserve is for. And the fact that we're draining it now, and we drained it back in March, is, kind of dangerous, because what if we do end up in a war? What if we end up cut off from petroleum? There's reasons we have a Strategic Petroleum Reserve, and it's not to boost the president's poll numbers when gas gets too high. And, I think maybe they're going to start buying oil again to refill the Strategic Petroleum Reserve. And of course, that is just going to have that much more upward pressure on the price of crude oil. And then, as we know, the price of crude oil, as that goes higher, everything across the board tends to go up, because crude oil is involved in so many aspects of the economy. Now, we are seeing these asset prices falling in a big way today, and like I said, I don't really think that this sell-off is going to stop anytime soon. We may see a rally, we may see a dead cat bounce, who knows? But there are lots of black swans waiting out there in the fringes of the economy, waiting to come in and trigger an even bigger sell-off, a bigger crisis. One thing we got going on right now is Japan has begun selling U.S. Treasuries, and typically they are a big buyer of U.S. Treasuries. So this is going to put some more downward pressure on the debt market. This is going to cause the cost of borrowing to move up. This article mentions Japanese investors have offloaded almost $60 billion in U.S. Treasuries over the past 3 months. And that's not a huge number, but the thing is that typically Japanese investors are buying U.S. debt, so the fact that they're not doing that anymore is already going to have an upward pressure on interest rates in Treasuries. And then to the extent that they begin selling, they're going to be a competitor with entities like the Treasury, with the Fed, everybody else who is selling debt right now. So this is definitely a harbinger of worse things to come. And, we haven't even gotten the quantitative tightening on the part of the Fed started yet, where they start to sell off Treasuries onto the market. That's scheduled to start next month. We've got this article. This was originally published in the South China Morning Post. China wary of Russia-type sanctions, but Beijing's financial nuclear bombs are a powerful deterrent. And this is all related to the Taiwan situation. China is concerned about the possibility of U.S. sanctions hitting them the same way that sanctions have hit Russia in the event that China makes a move on Taiwan, which, of course, they've been ratcheting up the rhetoric surrounding Taiwan for some time now. And here's a quote from Wang Yangli, who is a former vice president of the Bank of China. He said, "The huge foreign exchange reserves are hard won, and they are China's financial nuclear bombs with a powerful deterrent effect, must be used properly rather than arbitrarily, and cannot be easily slashed." And China holds a tremendous number of U.S. Treasuries, $3.2 trillion, which is more than double the second holder, which is Japan. So if we do see China make a move on Taiwan, if we do see a crisis surrounding that area of the world, don't doubt that those $3.2 trillion in U.S. Treasuries that China holds could be used as an economic weapon. We've got Putin today on Victory Day. This is the day that the Russians celebrate the victory over the Germans in World War II. He is using this opportunity to blame the West for the Ukraine war, claiming that the U.S. was planning an invasion of Russian lands, including Crimea. The situation in Ukraine is not getting any better. It is getting worse, and that could, of course, be a potential black swan. I know it's not a real black swan because these are all things we can predict. So, black swans, by definition, are things you can't predict. So, we've got all these seeming black swans that are clearly threats to the economy and to markets at the moment, but who knows what's lurking out there that we actually cannot predict. Another problem that we're facing as inflation creeps up is grain prices. This is from agriculture.com. This is a headline we're getting today. Grain prices rally sharply. So in addition to all of the economic turmoil that we're having, all of the conflict around the world, all the geopolitical instability, we're facing a situation where just the basic necessities of life may begin to become unaffordable for many people. And that is not going to be good for the social fabric around the world. When people stop being able to afford food to feed their families, they tend to get pretty upset. And, that's the sort of thing that can cause civil unrest. So this may be something that we're seeing around the world as well. 5 points from this article. The USDA has projected corn exports out of the Black Sea to fall by 6 million metric tons. Ukraine was responsible for more than 50% of global sunflower seed exports. And we're going to talk more about that in just a minute. Farmers in Ukraine have been encouraged to plant more wheat and millet and less corn and sunflowers for export this year in an effort to produce enough food for domestic consumption. And that's going to be a trend that we see moving forward. Just like how Indonesia just banned the export of palm oil, we're going to see more of this food protectionism where food policy in nations around the world is geared more towards ensuring that they have enough food for domestic consumption. And it makes sense because governments, they don't want to see that unrest that comes with rising food prices. Wet weather has delayed planting in the United States, so we're seeing weather events put pressure on food prices, and sharply high fertilizer prices accompany limited availability. And that is a result of less fertilizer coming out of Russia. We're seeing potash, nitrogen, all that stuff is becoming a lot more expensive, a lot more scarce, and that can pose problems in multiple ways. One, if you're not applying as much fertilizer and nitrogen to crops in, our modern agriculture system, you're going to get lower output, but also you're going to get less quality output. If you avoid adding nitrogen, for example, to wheat, you can get wheat with a lower protein concentration. So in addition to having lower yields of food around the world are going to be lower quality moving forward as we have to deal with a limited availability of fertilizer. So all of this bodes very ominously in my mind for the global economy because a food crisis is a real problem. That's a much bigger problem than the price of Etsy tanking, for example. And then we can see, if we take a look at some commodities charts here, here's the long-term chart for corn. You can see that we are knocking on record high prices in corn. Here's the chart for wheat. We are over $12 in wheat, which is a record high. Soybeans, same story, knocking on record high levels here. Here's a very notable chart. I mentioned that we were going to talk a little bit more about cooking oil. This is the producer price index by commodity for processed foods and feeds, shortening cooking oil and margarine. And you can see that there is a massive spike up in the price of cooking oil, even more significant than the other commodities we just looked at. So, this is going to be a real problem moving forward. And I mentioned weather events. India was one of these countries that was supposed to kind of offset the decline in wheat production that we would be seeing out of Ukraine and Russia. They said they would plant more. Well, they are getting massive heat waves, record heat waves across India this summer, and that is going to have a big impact on their crop production. So you can't count on India to make up any of the slack. So, this is really going to get ugly, I think, moving forward. Stock prices are going to continue to fall. Assets are going to continue to fall until the Fed is forced to reverse their policy decisions. Just like we see on this chart, I think we're going to see another little bump up to maybe, 0.75% where we're at now, maybe 1%, 2%. I'm not sure how high the Fed is going to be able to raise rates. They're talking about doing it more aggressively now, where they're going to be raising each meeting a half of 1 percentage point. So it's not going to take long before we hit that downward sloping trend line. on this chart. And, when that happens, I think something is going to break. We're already seeing signs that things are breaking in the economy and in the markets. But, this could get much, much worse in very short order. And when that happens, I believe the Fed is going to be forced to reverse policy. If they're forced to choose between fighting inflation or destroying the U.S. economy, the illusion of an economy that we have, because this is all based on the wealth effect, inflation of asset prices. It's not because we're becoming more productive. Don't forget that we just saw monthly trade deficits skyrocket up 22% to $100 billion a month. So we're definitely not being more productive. We're importing more from the rest of the world than ever. As we see assets continue to fall, there's going to be more and more pressure on the Fed to do something to intervene in markets. And I think that's coming shortly. And when that happens, that is when we're going to see gold and silver really take off. So, this decline that we're seeing today in the price of gold and silver, gold down to 1858, silver down to 2176. Of course, you can't get physical gold or silver for those prices. The premiums are still pretty high, but you can probably go out and buy some silver right now. If you're buying kilo or 100-ounce bars, you can probably get it for $25, $26 an ounce. And I think that's an absolute steal, considering everything that's going on and considering what we are going to see moving forward. So I'm still stacking precious metals. This is not financial advice, as you guys know. I'm just a guy on YouTube. But in my opinion, what I would like to do is keep some dry powder on hand, have some cash, because who knows? I mean, we could see, with all these potential black swan events out there, we could see a really big drop in asset prices in a very short period of time. Markets are definitely poised for that sort of behavior. So if that happens, I think there probably will be some opportunities to get maybe physical metal. I don't know, if we see a huge drop down in the price of silver like we did in 2020, and if it goes down to 12 bucks, I don't think you're going to be able to get physical for anywhere near that low price, but there probably will be some really big opportunities, say in the miners, in gold and silver miners, in energy companies, really any companies that produce real stuff that people have to buy. Because, when it comes to gasoline, when it comes to food, when it comes to commodities, there's some measure of inelastic demand there where no matter what the price is, people have to buy it. So I think that companies, agricultural company, energy companies, mining companies, companies that produce real tangible commodities, I think they're going to do very well moving forward. And so if we get a big crash in those sectors, I do think that will be some real buying opportunities and some real opportunities to make a lot of money moving forward as we enter into this much more inflationary environment that we're going to get if the Fed does reverse its policy. Because honestly, the amount that they've raised interest rates so far, 0.75%, that's not going to do anything to combat inflation over 8%. But we're going to see a really big acceleration in inflation once the Fed has to reverse policy. I hope you're all getting prepared. I hope that everybody is taking the opportunity to acquire some food right now while it's still relatively cheap. I hope you're all stacking some metals. Again, it's not advice, just what I'm doing, what I think is the wise move at this point. Have some cash on hand for the potential big drop that we might see. And just stay safe and get prepared, everybody, because this is going to be one heck of a wild ride. And as crazy as things are right now, I think they're about to get a lot crazier. And I just hope that everybody is getting prepared. So let me know what you think in the comments down below. What's the biggest threat we're facing right now? Where will the big opportunities be if we do get a big pan sell-off? I'd love to hear what you have to say. If you enjoyed this video and you'd like to see more videos about gold, silver, commodities, everything going on in the economy right now, food shortages moving forward, then check out the videos that are popping up on your screen right now, and I will catch you next time. Thank you all very much for watching. Smart Silver Stacker, out.